Hello, how are you? I'm Dr. Labhi from Dr. Labhi's Academy. Hope you are doing well. Today we will continue the financial management, what we have left in the last session. Is it? ACCA financial management. First of all, I will request you to subscribe to this channel, see till the end, and it is a continuity. I have marked in as 1 by 20, 1 by 2 by 20, like that. 3 by 20 means that is a series which I have made it easy for you to understand how it is going far. I kindly request you to subscribe to this channel, share this channel with the aspirants, with the known people in your friend circle who are planning to write exams, and watch till the end, plus the notification icon, and if at the end any comments, please write the comments and like the video. Okay, now we are talking in terms of the financial environment, financial management and environment as such. Okay, financial management environment, if you take into consideration what are the things we are going to study, discuss, is right. Now coming back to this, if you take the things into consideration, how the things will move. See there, when you are talking in terms of financial management environment, yeah, what is the environment? Entire environment in terms of markets, environment in terms of instruments, is it? Entire environment in terms of policies, is it? Now we will cover this. First I will give you a brief overview, so that by the time we start doing questions it will be easy for us. Whenever there is every country will have the policies. Okay, every country will have a policies. Policies is divided under two different aspects. One policy is a monetary policy, another policy is the fiscal policy. Monetary policy basically is by the regulator in terms of federal bank, is it? In terms of central bank, in terms of reserve bank, is it? These are the called every country either they will have federal bank, they will have a central bank, or they will have a reserve. And every country, every government, every year annually they will present the budget. Okay, this budget, the annual budget, is called as a fiscal policy. Okay, now what is the monetary policy and what is the fiscal policy? This we are going to cover. Second aspect, what is there? We are talking in terms of markets. Yeah? Type of market. It's almost the stock. We are indirectly talking about the stock markets. Okay. Next, when we say it's a markets are primarily divided under primary markets. Is it right? Primary markets and secondary markets. Is it? Primary, again there is second classification. Okay, I will tell you. Primary markets are the markets which issue first time, is it right? First time offer. Whereas secondary markets are, it is a stock exchange. Yeah? You are buying on from some other persons. Okay. Next, you will have capital markets. Is it right? You have money markets. Is it? Capital markets are long term, money markets are short term. Is it? Capital markets are long term. Long term is more than 1 year. Okay, short term is less than 1 year. This is the brief overview about these things what we have done. Talking about the monetary policy, we are talking about the markets as such. Now, if you have a complete understanding on this, hopefully we will have a more easiest way to understand. Coming back, we will start this. Wherever it is possible, I will give more detailed information and explanation about that. Which of the following is or among the elements of fiscal policy? Fiscal policy is divided by the government. It is a budget, okay, annual budget. Is it? Now, what happen? What the government will do? Okay, government, when we are talking in terms of a fiscal policy, is it? What the government will do? Government will take into consideration what government actions to raise or lower taxes. Government will increase taxes or government will decrease taxes. Where they will do this? They will do it annually, basically annually, okay, in the fiscal policy. This is what it is. Government action to raise or lower the size. See, money supply. Money supply is done with by whom? Money supply is done by the monetary policy, by the federal bank, okay? Either federal bank or the central bank or the reserve bank, is it right? This has been done by the monetary policy. Next, this is not the case. Government action to raise or lower the amount of spending. Government will spend. The government will spend on infrastructure. Government will spend on the salaries of its employees. Government will spend on the basically on the infrastructure. Government will spend. Is it government action to raise or lower as per the revenue, as per the amount generated by the government? Government will either increase the infrastructure spending or they can decrease the infrastructure spending. The answer is what? The answer is 1 and 3. Which two of the following statements are correct? Securitization is the conversion of illiquid assets. You see, what is securitization? Securitization is nothing but illiquid. See, when you say illiquid assets, you can say, you cannot put very clearly, illiquid is nothing but the long-term assets. Is it right? Illiquid is nothing but the long-term assets into a marketable securities. Means you have some you have some assets. What you do? We can go. We approach the bank and we can convert that securities into marketable. Means we can convert into short term. Okay, converting a long-term assets into cash. Again, when you are recovering, we'll get it back to them. Is it right? That means this is one of the options. The reverse yield gap to equity yields being higher than the debt. See, what happens? See, it is very, very beginning now, but there is something called as R, okay? Discount factor. If R increases, what will happen? The present value will decrease. But we should not say that 10%. See, if you have the option as 10% and 8%, we will go by 10%. But in reality, we will not go by 10%, we will go by 8%. Means we will see what is the present value. Means always make sure that the reverse yield gap refers to the, no, it is not, it refers not between equity and debt. It is the reverse yield gap is the debt yield, is it right? The debt yield on the bonds, is it? The debt yield, is it? The debt yield will be greater than equity yield. Because see, what we have learned in financial reporting is, so you should have a very good understanding about financial reporting, audit and assurance, the thing. In financial reporting, what we have read that profit before interest and taxes, is it? Debt is risk free, okay? Debt is risk free, and equity is risky. It is not the reverse gap. It is between debt yield should be greater than equity. This is not the case. Disintermediation arises where borrowers deal directly. Disintermediation arises. It's correct. Is it? When we are talking about this, no intermediation. Is there no intermediation arises when borrowers are dealing directly with the individual. Now, that's right also. Demand pull inflation occur when there is an increase in production cost. It is not demand pull inflation. This is the definition for cost push inflation. Is it? This is the definition for cost push inflation. Fine. This is what the thing. Now you have to work it out in this way. Okay. You have to make sure that how things are. Indicate by clicking the relevant boxes whether following statements are true or false. Coupon bearing securities have fixed maturity and a specific. What is the coupon bearing? Is they say that 5%. Is it right? 5%, 10 years. Is it right? 100 pounds. Is it right? Bond. When we say that this is otherwise called as a coupon bearing security. They'll have a fixed maturity and they have a specific rate of interest. Fine. In the discount market, funds are raised by issuing bills at a discount to the eventual redemption or maturity. See what is in the discount market? You will have 100 pounds bond. Is it right? What will happen? We are issuing at 95. This is the par value. Is it right? This is the issue value. Is it? What is the redemption? Redemption will be done at par. Is it right? Redemption will be done at par. In the discount means you are issuing at a lower price, but you will redeem issuing by discount to the eventual redemption or maturity value. Next, the principle. If you subscribe to this channel, share this channel, and any comments you just mention in the comment section. The principal objective of macroeconomic policy usually deals with the government. Include what's the responsibility of the government? Government responsibility is a full employment of resources. Is that you have to use the resources to the major factor all over the country. Is it right? It is not only to specific county, state, or region as such. It applies to all the government responsibility is it is a price stability. Government says that you should have economic growth, and this is the balancing the government budget. This is not a macroeconomic policy. This is a fiscal policy. Answer is C. Next. Governments have number of economic targets as part of their fiscal policy. Is it right? Which of the following government actions relate predominantly to what the government will do? Is it right? Decreasing interest rate in order to stimulate. See, interest rates is in the jurisdictions of the federal government. As you see, federal governments, federal bank is it? Sorry, it is with respect to federal bank. It is federal bank. It is a central bank. Is it right? It is a reserve bank. Is it right? It is the. This is not. This is not a fiscal policy. This is a monetary policy. Reducing taxation while maintaining the public spending. Is it right? Is it reducing taxation? Taxation relates to what? Taxation relates to the fiscal policy. Using official foreign currency to buy domestic currency, is it? Again, the currency is under the management of what? Under the management of the monetary policy. Monetary policy is nothing but we are talking in terms of federal bank. Again, I say federal. You will see. Okay, next. What is the borrowing money from the capital market? Public work. Public, if you are spending on the public work, it is going to be a fiscal policy. Here, 1 and 3 are monetary policies. Is it? 1 and 3 are monetary policies. 2 and 4 are fiscal policies. Which three of the following are key roles played by money market? I told you money markets are those markets where we are using the in less than 1 year. Time frame is there, is that 365 days. Providing short-term liquidity. It is short-term, okay? Money markets basically deals with a short-term, okay? Providing short-term liquidity to companies, banks and public sector. Providing short-term trade finance, automatically allowing an organization to manage its exposure to foreign currency risk and interest rate risk. Yes, see, foreign currency value is always fluctuating. It is a short term, it's not a long term. Rate of interest is also what? Rate of interest is every 3 months. The central bank or federal bank or the reserve bank revise it. Is it right? Rate of interest is 3 months. I will say, is it 1% rate of interest is equal to 100 basis points. I will discuss this at a later stage, okay? At a later stage. Now, what is the formula for interest rate? It is a Fisher effect, okay? It is a Fisher effect where there are 3 variables. You will have the real rate, you have the inflation, is it right? You have the risk. Is it? Risk will be with respect to the lending as well as with respect to borrowing. Inflation is based on what? Inflation is based on market. And real rate is based on what? Real rate is based on that has been done by the federal bank. This is how the rate of interest has been derived. What is the short term? I will come to that. Okay, wherever is there, I will immediately give the explanation for you so that even I will not forget about it. It will be easy for us to understand. It is short term. It is a short term for trade finance. It is with respect to for dealing long term. Long term is not a money markets. Allowing company to issue, say, even to raise money. It comes where? It comes in the capital markets. Fine. The answer is what? The answer is A, B and C. Which of the following are money market instruments? Okay, which of the following are money market instruments? Certificates of deposit is short term. Corporate bond is a long term. Commercial paper and treasury bills both are short. Which three of the following are common roles in the treasury? Treasury is nothing but dealing with cash, okay, with ready cash. Function within the short term management of resources is treasury. Is it short-term management, long-term maximization of the wealth? Is it? We will have, so what the treasury will do? Treasury will invest in the share markets. Okay, whenever there is a surplus will be there. Long-term maximization of market share. Yesterday, in the last session, I told you, market share is a relative term. Is it? What is the, we cannot say. Is it? It's not a treasury function. And most importantly, risk. Treasury will take what they will do? They will just manage the risk. Management of account receivables, it is related to current assets, okay? And financial reporting, it relates to financial accounting. What are the three functions? A, B, and D. Which of the following is the difference between primary market and second? I told you, again I will explain. Primary market, and see, when I am explaining this, make it sure that it is one time, it is enough for you. You will remember it till your examination and further also. Primary markets are the markets which are issuing what? New securities. Secondary market are those market where we are trading the securities. Trading the securities means existing securities. Is it right? The existing one. Which of the following the difference between a primary and second? Primary markets relate to the sale of new securities, while secondary markets are where securities are traded after the initial offering. But read the other options also. Both primary and secondary capital markets relate to the where securities are traded. No, both, they will not be both, okay? They will not be both. Both primary and secondary markets relate to sale of, no, it is only the primary market but not secondary markets, new securities. Is it? Primary markets are where stocks trade and secondary markets are there where no. In both the markets stocks will trade, but here in primary new stocks, and these are the existing stocks. Answer is A. Which change in the monetary policy will influence without the following factor? You are changing the monetary policy, is it right? When you are changing the monetary policy, what will happen? Is it? When you are changing the monetary policy, monetary policy consists of what? Monetary policies consist of inflation. Monetary policy consists of money supply. Is it right? Monetary policy consists of rate of interest. Is it right? Rate of interest. Monetary policy consists of foreign exchange. Forex. Is it right? Now, level of, it will affect which of the changes and will influence what? It will influence the level of exchange rate. See, if the Federal Bank doesn't have foreign exchange reserves, is it right? They will buy the reserves. Is it? They should have a quick sufficient cost of finance. What will happen? The rate of interest will increase. R value will increase. Is it? If the R value will increase, definitely rate of interest is increasing, purchasing power will decrease. Rate of interest will increase. What happens? We will say it is a purchasing power or it is a borrowing. Borrowings, what will happen? It will decrease. It affects the cost of finance. The level of consumer demand. Is it? The level of consumer demand. Definitely what will happen if inflation increases? Is it right? If inflation is increasing, what will happen? Definitely the purchasing power, is it right? The purchasing power will decrease and the level of inflation. Answer is 1, 2 and 3 and 4. Which of the following is or usually seen as forms of market failure? Where regulations is imperfect. See, imperfect competition. Imperfect competition will never work. Is that imperfect competition will never work? We want perfect competition. Is it? In economics, imperfect competition means you will have monopoly. Is it? What the countries are doing? They are talking about the consumer protection. They are talking about something which is going to eliminate monopoly. Is it? They are planning to eliminate what? They are planning to eliminate monopoly, oligopoly also. Is it right? Social cost are external. See what happens if there is social cost. Here we have to be very say environment cost. Now we are very much concerned about environment cost. Is that if you don't have an environment policy within the company, within the country, what will happen? It will have a large implications. That is the reason. Who are the stakeholders? The public is one of the stakeholders. The public is one of the stakeholders. That is the reason. Where there is a market failure, where regulations may be the solution. We need regulators. Imperfect information is that what happens? You have to give perfect, complete information when you are preparing the financial statement. What you are going to say, we will say that it is true and fair. Yeah? When we say it's true, it means when it is going to be like that, we should have a. These are the market failures where regulations is needed in terms of 1, 2, and 3. There are four main types of finance. There are two main types of financial market. Capital markets within each of these primary and secondary. Is it? You have a capital markets, you have money markets. Is that? I will just make it again say. Is that you will have a capital market. Is it right? You have a money market. Under capital market, what is there? Again, you have a sub-classification. You have a primary market. Is it? You have a primary market. You have a secondary market. Which three of the following statements are true? Yeah, which three of the following statements are true? It's not three. Okay, fine. Primary markets allow the realization of investment before their maturity date by selling them to others investors. It is not the primary market, it is the secondary market. The secondary market. Primary market deals with the new issue of funds. Capital market consists of stock markets for shares and yes, capital markets are the long term. Okay, money markets provide long term. No, money market will never provide long term. It is to my knowledge, to my understanding, this is 2. Then maybe I'm safe, but to my understanding it is 2 or 2 of the following are true. Okay. Anything is there, you can put it in the comment box, we can work it out. Next. Indicate by clicking the relevant boxes whether the following statements, interest rates, smoothing is semantic, but smoothing is you have to join the end points. Okay. Is the policy of some central banks to move official interest rate in a remittance of relatively stars. See, just now I told you, 1% is equal to 100 basis points. See, the interest rate is very, very sensitive to the market. Is that if they will never, they will increase how much? They will increase 25 basis points. That's the, see, 25, 50 basis points. Means the moment interest rates are increasing, it means what? It means the value of money will decrease. Okay, 9% to 10%. Don't think that 10% is there. I will go in detail about when it comes. Okay, I will explain you in detail how it will work. Whether you are going to favor 10% or you are going to say favor 15% or you will say it is 5%. Is that it's very technical. It's not like we are not just going by the numbers. You have to prove it. Why 15% is not healthy and why 5% is healthy. Okay, I told you if value of R increases, present value will decrease. Yeah, what happens? See the things how it happens. You have the rate of interest. Is it there are two options. Is it option one and option two? Is that option one says that you are increasing slowly and steadily. Okay, you are increasing slowly. So sometimes maybe you will not increase. Maybe sometime after you are increasing. Whereas option two says that you are increasing directly. It is not healthy. Interest smoothing is you are just going step by step. While some central banks move official rate of in sequence of relatively small steps in the same direction rather than waiting until making a big. It is true. If government wish to influence the amount of money held in the economy or the demand for credit, they may attempt to influence the level of interest. See what happens if interest rate is decreasing? Is it right? If rate of interest is decreasing, what will happen? Demand for money or loans, is it right? Demand for money or loans will increase. If interest rates are increasing, demand for money or loans will decrease. See, these are the rules which are going to help you a lot. Is it? Which are going to help you a lot as. Now, this is what is it. If government wish to influence, what they will do? If one wish to influence the amount of money held in the economy or demand for credit, definitely they will either increase the rate of interest or they will decrease the rate of interest. A variety of corporate governance rules. See, corporate governance, just go back to F8, okay? F8, audit and assurance. The rules have been introduced in different countries, but which are the principles common to all? Is it? And they are typically the chairman and executive officer should not be the same individual. Understand? This is one of the rule. Is it? Non-executive directors of the board should prevent the board from being dominated by the executive directors. Yeah? See what happens when you are having the board, is it? You will have the chairman, you will have equal, is it? If you have five executive directors, and five non-executive directors. One of the rule of non-executive director is there should be one non-executive director. These are otherwise called as independent directors. One of the rule of independent director for non-executive director is they should have a financial qualification. Is it? This is what we have done in audit and assurance. Is it? Now, our board should prevent the board from being dominated by executive. Next, the audit committee should solely consist of the audit committee should be solely consist of non-executive directors. A remuneration committee should be established to decide remuneration. You will have the remuneration committee. Is it? What is the answer? 1, 2, and 4. When you are coming for the next class, in the next, prepare for working capital. Okay, just go through current assets, current liabilities. Take it, have a look on that. Okay, I will go by sequence only. I will not jump from one to another. Okay, now which of the following statements is correct? The moment, see that we have to little bit now, we have to be very, very smart. Okay, when they say is correct, means it is only one option. When they say are, definitely direct taxes are levied in one set of individuals or organizations, but may be partly or wholly passed on to others and are largely related to consumption or not. See, direct taxes is related to income, salaries. Okay, salaries. That is the direct taxes, personal taxes. Indirect taxes are levied directly on income. No, indirect taxes will be on the consumption. Okay, how much you are spending. You are paying VAT. Is it right? It is an indirect tax. If you are paying VAT, it is a indirect tax. You should have a very comprehensive understanding about all the subjects. Then only half of whatever you are learning previously, don't forget about that. Okay. A balanced budget occurs when total expenditure is matched with total. That is the reason total expenditure will be equal to total taxation. A deficit budget occurs when total is less. No, deficit will occur when the total expenditure is more than the total taxable income. By clicking the relevant boxes, whether the following statements are true or not. Demand pulls inflation might occur when there is an aggregate monetary demand in the economy, and hence demand for particular goods and services enable companies to raise prices. This is the definition of demand pull inflation. Is that demand pull? Little bit we have to be cautious about the wordings. Okay, demand will occur when there is aggregate demand in the economy. When there is a demand in the economy, then only we will have a demand pull inflation. The demand for particular goods and services enable companies. What happens? Definitely the demand is increasing. The product price will also increases, and the profits for the company also increase. Cost pushed inflation. Yeah, I am writing this. This is very just revise this once before examination also. I am putting one star mark here. Cost push inflation occurs when there is an increase in production cost independent of the state of demand. Cost push means the value product raw material prices are increasing. Is it? This is also true. Which three of the following are true in relation to certificates or deposits? Is nothing but the deposits which you are keeping with the bank. Okay, you can keep with the bank whenever you want. You can liquidate it. You can convert into cash. There is evidence of a deposit. This is the evidence. Is that this is the certificate means they give you as a evidence. Fine. They are not negotiable. No, they are negotiable. Is it? They are negotiable. They provide the bank with a deposit for a fixed period at a fixed rate of interest. Is it? They are going to say that it is means you are depositing. You will have a deposit in the bank. They say that 7% for 2 years. You have a fixed period and a fixed rate of interest. They are coupon bearing. Means sometimes what will happen there, if you have deposit in the bank, is right? You will say that half yearly interest should be credited to my account. Quarterly interest will be credited to my account. It is nothing but it is a coupon bearing industry. They are not tradable. No, they are, just now we have said they are tradable. Answer is what? Answer is A, C and D. Which of the following is least likely to be reason to see stock market? See, when a firm will list its shares on the stock market, definitely there are so many advantages. Is it? It's nothing but as simple as that. It is a risk. One person is selling risk, and is it? Another person is buying risk. In simple words, as a investor, who is buying risk? The investor. Who is selling the risk? It is the owner. You are selling, is right? You are selling the risk. You invest, and future what happens, God knows. Is that right? So this is what happens if you are seeking a listing. Definitely, what are the least likely? Is it? This is high likely. Is it? This is the enhancement highly likely. Is it? Transfer of capital to other users. Yeah? You are transferring the capital to other users. New. It is also highly. Is it right? It is also. I will put like this. It is also highly. You are transferring to improving existing owners control over the business. No, it's not improving. Your existing owners control will decrease. Okay, access to a wider pool of finance. Definitely, if you are a listed company, banks will come forward and give loans. Is it right? The answer is what? The answer is C. Which of the following is not typically a principal objective of macroeconomic? What is the principle? It's not. Okay, we have done in the beginning. To achieve full employment, it is the principal policy. Yeah? To achieve economic growth is a principal policy. To achieve, is it next? To achieve a balance of payment deficit. Yeah? To achieve to achieve appropriate distribution of income and wealth. See, there should not be an inequality. There should be an equality. Yeah? That is the reason government will support to those people who are below poverty line. Okay. They will give sometime in some countries they will give unemployment support will be there. Okay, that's the reason. And this is also a macroeconomic policy, and whereas this is not a macroeconomic. What is the principal objective? It is not a principal objective. To achieve balance of payments deficit, is it? It's not a macro. Which three of the following are having a centralized treasury? It's a very simple one, is it? So what happens centralized? If you have a centralized, cost will decrease, specialist will manage the courses, the cash, and basically we can have borrow the funds at a lesser cost, is it? If you know what is the overall requirements of a treasury, centralized treasury department with respect to large group of company. No need for treasury skills to be duplicated. Necessary borrowings can be arranged in bulk. See the keywords, that's very important. Okay. See, you have to understand the techniques when you are writing the ACCA exam at keener rates than the smaller amounts. Fine. The group foreign currency risk can be managed much more efficiently since they can appreciate the total. They can see what is the total request. See, there will be advantages, there will be disadvantages. Okay, we are not talking about specifically. Local. This is a disadvantage. Okay, local operating unit should have a better feel of local conditions than head office. So then, what is the purpose existence of a head office? Is that if you see local, you are borrowing. So when you are borrowing local, see what will happen. See that we are talking about a large group of companies. Is that group of companies? When you have large group of companies, assume 1, 2, 3, so many difference are there. Some companies will have surplus. Okay, some companies will have surplus. Some companies will have deficit. Okay, some companies will have deficit. What we are not approaching an external party. Okay, we are just managing. We are just pooling the resources from the surplus unit and we are giving to a deficit unit. We are internally managing the functions. Is it? That's what this is not the case. Okay, divisional managers will be motivated by having less responsibility. There is no concept of responsibility as such. Okay, fine. Investing in a small or medium-sized business is inherently more risky than investing in the large company due to large lack of business history and lower level of see if everybody wants to invest in a larger company, is it? Nobody wants listed companies as well. Nobody wants to invest in a small and medium enterprises. Is it right? What is the problem with respect to these two are over the accounts and record? What is frequently used term to describe the difficulty? Difficulty is with respect to what? Difficulty is with respect to funding. People will not come forward to fund small and medium enterprises. People will come and people want to invest in a large reputed companies. Okay, that is the basic problem when you are talking in terms of the gap between the small and medium enterprises and large companies. Which of the following financial instruments will not be traded on the money market? Commercial paper will be traded, it is short term. Loans will not be traded. Treasury bills is a short term. Certificates is all are short term. Whereas this is a long term. Which of the following government actions would lead to increase in aggregate demand? See, increasing taxes, is it? Increasing taxes, keeping governments spend. See, when you are increasing the taxes, is it? When a government increase taxes, is it right? What will happen? The consumer spending will be less because you are paying more. Okay, you are paying more. Decreasing taxes and increase. See, when you decrease the taxes, definitely what will happen? An increase in government's expenditure should be more. Okay? In any case, if the government spend more, they spend on projects, they spend on infrastructure, automatically what will happen? Definitely there will be a demand will increase. Is it? Decreasing taxation and increasing expenditure will increase the demand. Decreasing money supply. If you are decreasing the supply, how can you expect that the demand will increase? No. Decreasing the rate of interest. Rate of interest decreases. Is it right? What will happen? Borrowings will increase. Okay. Answer is 2 and 4. Which two of the following acts are carried out by financial intermediary? What the financial intermediary will do as a finance company in banking sector is that they are not transforming interest rates. Is that they are not they are transferring maturity. Is it right? They will borrow. They borrow in terms of deposits and they will lend in terms of loans. From different times, okay, transforming the maturity. They borrow for 3 months, 6 months, 5 months, 1 year, 2 years, and they will give loans. They are transforming the risk, is it right? They are taking the borrowers. See, they are buying the risk, is it right? And they are selling the risk. As simple as that, is it right? They are selling the risk. If you are giving loans, it means you are selling the risk. If you are taking the deposits, it means you are buying the. Means what they are doing, they are not talking about the transfer, they are not interest rates, nor they are talking foreign exchange. These two are not related to a financial intermediary. Okay, see, transferring maturity and transforming the risk. Next, when you are coming back, we have to. Next session will be on the working capital. By clicking the relevant boxes, whether the statements are true or false. A prospective merger will need to result in a company having a market share. There is no condition that there should be a market share of greater than 80%. Nowhere has been written. Nowhere. Is it right? It is false. A government may intervene to weaken its country exchange rate in order to eliminate a balance of payments deficit. Is it? See, government will intervene. Is it? If to weaken its country exchange rate. You see, what happens if you have any balance of payments issues, the government will interfere and they will check. The checks and balances will be there in order to eliminate the any balance of, means what happens, exchange rate reserves. Is it? Foreign exchange reserves are very important. If foreign exchange, see, the country's financial health position is determined by the foreign exchange reserves. If the foreign exchange reserves are increasing, the currency value will be strengthened. Yeah, the currency value will be strengthened. Is it? This is what it will interfere. A relatively high rate of domestic inflation will lead to strength. No, if rate of interest increases, what will happen? The value of currency will decrease. It will not strengthen the currency. Government fiscal policy, it is not the government fiscal policy, it is the government monetary policy. Fine. These are the things which you should be very clear. Okay, go one by one. You just go through it. Subscribe to this channel, and I will come up with videos, recordings as and when it happens. Okay. Apart from this financial management, on my channel you will come across F6 taxation, UK taxation, Financial Act 2022. You have financial reporting is there. You have audit and assurance is there. Okay. Thank you so much. Take care. We will get back to you in the next session.